Hello everybody, this is the structure segment of the Core Concepts course. By now we've been through all of the webinars together, and this course is simply designed to help you guys freshen up on any concepts when you need it without having to sift through hours of webinars. If you aren't up to date with all of the webinars, you should go back and watch those because you get the most value out of those over this. Again, this is just short form, bite-sized educational content, and it is not designed to teach you everything. If you want value, go back and watch the webinars or participate in future ones. That way you can ask questions or you can hear information that was given as a result of your peers asking questions. Okay, so the Oracle system, we view structure in a very unique way. We view structure within a three-class system. We have institutional structure, we have swing structure, and we have substructure, okay? Notice here that I've referred to these as points, okay? So points are referring to the highest point and the lowest point of the given structure. So in this case, this would be an institutional structure level or institutional structure leg. And we'd be looking at the institutional structure point at each vertex, or the high and the low. This goes for swing structure and it goes for substructure, okay? I've organized these in order of importance, okay? Institutional structure is the most important structure that we use because it drives the majority of our bias and trade direction, okay? Normally, what you've likely been taught is that swing structure is the most important and heavily weighted form of bias. How we view the markets is institutional structure points. And as you'll learn shortly, if you don't already know, institutional structure points monitor the flow of orders, or in other words, order flow. Whereas swing structure simply simply monitors the higher time frame direction and higher time frame order flow. But as intraday traders, we can effectively use intraday order flow to take trades as the leg develops on a higher time frame, rather than waiting for extreme points that may come a few times a month. We're able to trade multiple times a day because instead of having one trade here and two trades here in the direction, we can have 1, 2, 3 trades, 1, 2 trades on the downside, and then another 1, 2, 3 trades, potentially 4 trades here, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trades, potentially able to take 10 trades, or 11 if we want to count this one. Whereas only focusing on swing structure, we'd only have potentially 1 and 2 trades. Okay, so how do we define these structures? What are the characteristics of them? Institutional structure is characterized by a sweep of liquidity or a rebalance of old imbalance, also known as a tap into a fair value gap, FVG. Okay? Points of any kind, well, points, institutional points, I should say, are confirmed when there is a break of structure. A good question to ask is, well, what is a break of structure? A break of structure cannot be a simple break of sub. It needs to be a break out of the leg or of the previous institutional leg, okay? So for example, here we have institutional structure point, which we will now refer to as ISPs. We have an ISP here, and this pushed price up and created a high here. Okay? Now, what is a break of structure? A break of structure is when a newly formed ISP breaks the high that was produced by the previous ISP. Okay? So, if we had structure like this, and this ISP here broke structure here, this is still unconfirmed. It is only confirmed when it externally breaks out of the previous institutional leg. So we view the leg like this. Right? Premium and discount tool, as we all know. This institutional structure point is only confirmed when we break out of this range, okay? Of this dealing range. And then it creates a new one. And it is only a break of structure when a new ISP forms and breaks out of the dealer range. Okay? So if it breaks here, this is simply internal structure. This is all substructure. And it is not a confirmed ISP until it breaks out of here. Okay? We're going to get into why ISPs are so important in the following segments, but for now, we're just going to focus on how to map and characterize each one of these structures in our 3-class system. Swing structure point is the second most important type of structure. It is characterized by, in a low, when we're looking at a low here, it would be a low, which is an ISP, right? All swing structure points are ISPs, okay? It is an ISP that has a higher ISP to the left and a higher ISP to the right, okay? A swing structure high is a swing structure point with a higher one on the left and a higher one on the right, okay? This here. Sorry about that, okay. The next form of structure is substructure. Substructure is any structure that does not sweep liquidity and does not break structure, okay? So substructure is any structure point here that does not sweep liquidity, it does not break anything substantial. This, until confirmed, is classified as substructure by default until it's confirmed. But when we're looking at institutional structure, we can look at areas where they're likely to develop and call them unconfirmed institutional structure points and then trade in that direction. Okay? And that is really what our whole model is about. It's about trying to figure out where institutional structure points will form and then trade them as they develop. But if there's no break of structure and we start pulling up, this is still considered a substructure point, okay? Institutional structure points, go back again, are formed from liquidity sweeps and fills of imbalance, or FEGs. Price does not need to fill the entire imbalance, simply needs to tap in, and then it is then confirmed by the break of structure or the breakout of the previous institutional leg, right? The institutional dealer range. A swing structure point breaks when we simply break a previous swing structure point, okay? Notice this is not a green dot. Why isn't it a green dot? Because we don't have another green dot or another ISP that is lower to the right and another one that is lower to the left. So we still assume here that structure is continuing bullish until we break down, create a lower ISP to the left. We assume that swing structure is not complete in its formation and we should continue up, right? So up until we've had a break and a production of a new ISP on the right, then we have one on the left. Now we can then affirm that swing structure is finished development and we can start a pullback phase to produce a new swing structure point. Now, how do we track structure? Structure, ISPs, change of trends. Okay.